Infosys and HCLTech are both slated to announce their results for Q3 FY23 on January 12th. Here's a quick primer. What the factors to look out for are from both companies. First up is Infosys. The third quarter is a seasonally weak quarter for the IT industry, characterized by fewer workdays as well as furloughs which were higher than expected this time around amid a challenging demand environment and macroeconomic headwinds. Analysts estimate revenue growth to come in at 1.1% quarter-on-quarter in constant currency terms. EBIT margins are expected to expand by 20 basis points due to the depreciation of the rupee, easing of supply-side challenges, and pyramid rationalization. Profits are expected to go up by 6.5% according to analysts. Now, coming to demand. In Q1, Infosys had called out some softness in mortgages and financial services and in retail. In Q2, the company said it was seeing caution in telecom and high-tech, and commentary around softness in these verticals will be watched. Next is geographies. In terms of geographies as well, Infosys has the most exposure to US at over 60%, followed by Europe. With demand seemingly holding up well in the US for now, commentary around the impact of the slowdown in Europe will be watched as well. On the TCV front, Infosys only reports deals that are signed that are in excess of $50 million. Deal wins were strong in Q2 at $2.7 billion, but will this large deal TCV be lower from last quarter is another area that will be paid attention to. Things that will be in focus are the nature of deals, commentary on the demand environment and pricing environment, and the deal pipeline, as well as attrition. On the guidance front, Infosys is expected to maintain its revenue guidance of 15 to 16% for the full year, as well as its margin guidance of 21 to 22%. Next up is HCLTech. During its investor day in December, HCLTech CEO C. Vijay Kumar indicated that revenue is likely to come in at the lower end of its guidance due to greater than expected furloughs and challenges in the BFSI and high-tech segments. There was also an indication of slowdown in discretionary spending in the tech, telecom, and other verticals. Analysts had said that this commentary was a function of the company's exposure to volatile products as well as the weakening of spending in verticals that it has previously called out. These factors are likely to lead to revenue growth being impacted in Q3, and in constant currency terms, it's expected to report 3% revenue growth quarter-on-quarter. EBIT margins are expected to expand by 94 basis points due to the easing of supply-side pressures, rupee depreciation, as well as a rebound in the company's PNP business. The company is expected to maintain its revenue guidance of 13.5% to 14.5% and EBIT margin guidance of 18 to 19%. Analysts do estimate profits to grow at 8.7%. On the demand front, HCLTech has had healthy deal wins, but its exposure to project-based R&D and lower exposure to BFSI has been flagged as a matter of posing risk. Commentary will be watched for its guidance, IT budgets for the 2023 calendar year, deal pipeline, the demand outlook, and pricing environment.